Welcome to the InterMarket Analysis video update. This is a video that is done every week, and I not only look at intermarket analysis, how different markets interact with each other, I also do a pretty extensive breakdown on the current valuation of the S&P 500 on a historical basis, as well as looking forward. I also do a pretty extensive go-through of growth and value. Generally, with growth, you want to buy low and sell high, like Amazon, Apple, Google, Nvidia. These are growth stocks. And when the growth is outperforming value, the market tends to really go up and show more strength. When value starts to outperform growth, that's when it's getting more defensive. And we might be seeing a bit of that unfold. Now, we're coming into September right now, which historically has been a weak time for the markets, not only over the last few years, but if you look at this historically. And please look at the daily video that I do. I go through some seasonal tendencies that happen, at least on a historical basis. Doesn't mean we're going to actually stick with those, but it gives us a good guide to use. And also look at the weekly video. I have some seasonal charts there that you might find helpful, because we're seeing some changes right now. And then I do go through other markets outside of the stock market. I also look at other indexes inside the stock market, as well as other sectors, because taking all of this together, we're trying to look at the big picture here to see how is that going to affect the S&P 500 ultimately. And then if you're dealing with a particular sector, a breakdown of the S&P 500, there are 11 sectors. Or if you're doing an individual stock, that can quite often have a real impact. So the idea behind this is to look at the big picture and then whittle it down to whatever picture actually applies to you. And this is being prepared for Tuesday, September 3rd. The market will be closed on Monday, September 2nd for Labor Day. I do have a thing called the SPXInvesting Program. Now, if you want early access, what I mean by that is as soon as it's available, I upload it to the website here, where I delay the videos going public on YouTube and Rumble. You can join. It's still free for right now. I was looking at locking that down in August. Now I may be going on a trip at the middle part of September to the beginning of October. I don't know if that trip's actually going to happen because it's supposed to be going to Israel. And with all the upheaval there, we don't know if that's actually going to cancel the trip. I tried to go a year ago in October of 2023, and then everything blew up there, figuratively. Well, I guess literally too. So I'm just kind of keeping an eye on the news as to whether or not that's happening. In the meantime, I've delayed locking down the SPXInvesting Program website. There are additional videos that I post there. There's going to be even more once I do lock it down, and there's information that members have access to, including early access to the daily videos and all the weekly videos. But feel free to check that out. There's a link below this video that'll take you to the website. There's also a link that'll take you to an overview of the program. Here's an email address where you can contact me if that is something that is of interest to you. Also, the daily video is the real foundation of my analysis. You notice down here is InterMarket Analysis, this video. It's just one of many weekly videos that I do, but everything ties into the daily video, and that's where you get the most analysis and commentary, and we can actually see things starting to happen before they actually happen. But everything here is supposed to be taken together. All right, first area that we look at is S&P 500 valuation. What you see here is the PE ratio, the price to earnings ratio. What's the current price coupled up with what are the earnings doing right now? But this looks back. This looks historically. And what they've done here with the chart is we have a PE ratio of 20. When we get to 20 or above, the market is considered to be expensive. When we're between 11 and 19, 15 being the sweet spot there, the market is considered to be fairly valued. And when we're at 10 or below, the market is considered to be inexpensive or cheap. This goes all the way back to 1980. And you see, here's the value of the S&P, and these are the current valuations at that time. Well, right now, we're well above the historical look back at earnings, because it's ultimately earnings that drive company prices either higher or lower. Then down below, I break out, where are we with the S&P in relation to the red dashed line, where we're far above that right now. So on a historical basis, we're considered to be expensive. But we don't use this as some kind of timing mechanism. If you look back, going back to 1980, and you got out of the market anytime we were expensive, you would have missed some of the biggest gains that have ever happened. We use this for informational purposes. Now, that's different than a fundamental analysis type of approach. We do use some fundamental analysis, mainly the news and economic reports, to look at it, but we don't do it on a valuation basis just because it can be misleading at times. The idea with fundamental analysis is when you want to buy a stock or an index or a sector when it's considered cheap, when it's anywhere between 10 or below, you're good with hanging on to it as long as it's between 11 and 19, but then you're looking to sell it when it gets above 20. And that has some valid points. But like I said, you would have missed some really big gains because even though the market is overvalued, that's when it tends to perform the best. Also, the same basic chart here, but labeled with different events that have happened going back to 1980, and then what the valuations were at that time. Now, this was put out by Isabel Net. It's a blog that they update every day. I usually go through a lot of these charts in the daily videos and in the weekly video. I don't usually include many of the charts here in the intermarket analysis video, but I did this time because it has to do with valuations. This is a combined PE ratio. And what this does is it takes the PE ratio of just the tech sector, media, which is communication. That would be, like internet companies, and then telecommunication as well, which could also be in the tech sector as well, and figures out what is the PE ratio just of those areas of the market. And we're coming in with a really high score of around 40. If you look over here at the scale over on the left, if you take that out, we're still well above 20 looking at this chart. Now, I have other charts that kind of contradict this, but there are different ways that people figure this out. Now, what this is, I refer to this later, and it's going sideways, so it's a little hard to read. We have the PE10. That's developed by Robert Schiller, and I'll deal with that chart next. And then they also combine the 12-month trailing earnings, and they also combine it with the forward PE. Well, I break those out into separate areas where they're trying to combine them in this chart. So no matter how you look at it, the market is considered to be expensive right now. Now, just looking at the Schiller PE ratio, which is also known as the PE10, because Robert Schiller developed this where he smooths out the earnings over a 10-year period of time, and his reading is coming in at 36.43. Here's a historical chart of the values for his PE ratio. Then to also get a little bit more context, we look at the median, which is just under 16. Right now we're at 36. And the mean is just over 17. Right now we're at 36. So even looking at this, the market is considered to be expensive. But we've been seeing this now for a number of years. So it can go on with this kind of a reading for an extended period of time. Now, the market looks forward, and in that chart from Isabel Net that I showed you, it takes the forward PE ratio into account. This just looks at the forward PE ratio. This is a chart developed by Edward Yardeni, who's an economist, and actually an economist that I listen to. Most of the time, I don't really listen to that crowd of folks, but he seems to make some sense. He's written some books. He has a website that I subscribe to, and he does videos that are on YouTube that might be well worth some of your time. But looking at this going forward, we have the purple area here. These are the mega cap 8. These are the magnificent 7, whatever you want to call them. This is the forward-looking PE ratio. It's coming in at 29.3. We still use that 10, 15, 20 scale. That's a static number. Now, some really criticize that static scale. They think it should be more dynamic, and I agree. But you just kind of have to look at this in the context of what's actually happening. Folks are willing to get into the mega cap 8 stocks because they have a lot of higher growth potential right now, but they're coming in at 29.3. What I focus on the most is the red line. That's the forward-looking PE ratio for the S&P 500. We're above 20, even looking forward. Even though earnings are still looking okay and they're projected to go up into the future, we still have a reading of 21.1. So the market is expensive, not only looking back, but also looking forward. Then we go down here where we're seeing the mid caps and the small caps, and the mid caps are coming in at 15.8, a little bit above that fairly valued area, and the small caps are coming in at 15.4. Well, we've seen some favor with small caps that can't seem to really get sustained, but they are showing some improvement, and they haven't really been able to break out of a range. But this is when those stocks, the smaller companies, the small and mid caps, become more attractive because folks feel, well, the large caps are so expensive and the mega caps are really expensive. I want to get into some cheaper stocks here now and try to see if those will actually go up. The only problem with this, it's the large caps and even the mega caps. That's where the earnings are at. Not so much with the mid caps, but with the small caps, the earnings just aren't there a lot of times. And so you have to look at a lot of different things to justify getting into a particular part of the market. Okay, then another area is growth versus value. First, this is a pure growth index for the S&P 500, looking like it's coming up. We had that decline going into the first part of August, and then it bounced back up above its 50-day moving average, and the 50-day moving average is above the 200-day moving average, so it's in an uptrend. Then we look at value, also looking pretty good right now. In fact, really starting to break out here. And this is producing a bit of a concern because this is what the smart money gets into when they're afraid the market's going to go down. And we're potentially coming into a weak seasonal time with September not performing all that well, and sometimes going into October. Is this the smart money trying to position themselves before we get ready for a decline? Even though in the daily videos and in the weekly video, we're still positive. Now, we're looking overextended, and we've been going sideways a lot with the S&P on the daily charts. We're still looking good longer term with the weekly charts, but we want to be ready for things and see them before they actually happen. Where this becomes the most useful is when we do ratios between growth and value. You can see where on the top chart here, the growth has really been outperforming, but pulling back, we came down to the 200-day moving average with this ratio. We started to bounce back up, but now we've been falling back a little bit lately. That's a little bit of a concern. Then, just because this gives us a little different perspective, we look at value versus growth on the bottom, where value is underperforming. It was starting to come up, almost made it to the 200-day moving average with this ratio, came down. Now it's starting to tick back up again. So this is something bigger picture that we're keeping an eye on. Another growth versus value type of measurement uses these index, a little longer term chart going back to 2006, showing how growth is outperforming value, but pulling back now. This is an inverse where we look at value to growth, where value has been underperforming, but starting to bounce back up. Then we look at some ETFs, growth to value, where growth has been outperforming. It was really breaking out, coming back down, starting to go up again, now starting to come back down. And then we look at a little shorter term chart. This is value to growth, how value is underperforming, bouncing back up, pulling back, now potentially starting to go back up. And then here's another growth to value. I look at a lot of different things. These are all different indexes. They're different time frames. They're different ways of looking at all of this, where we're pretty much seeing the same thing. So growth is still outperforming longer term, but it pulled back. It started to improve as we were going up in August. Now it's been coming back down. And this is a little cause for concern, even though we're not really seeing that on our daily or even weekly charts yet. We just want to keep this tucked in the back of our mind. Then we look at a growth ETF and a value ETF. This was doing better. It really weakened here in July and into August, started to bounce back up, coming back down, and is still inside the rainbow and declining. Another little concern. Then we look at value versus growth. Value had been underperforming, bounced up, pulled back, now starting to show an improvement here. Then break it down a little more. We look at just the small caps, and we do a growth to value ratio here. See how growth is really going down when compared to value? The mid caps, okay? Now, even though the mid caps and the small caps, people get into those usually for growth. Well, the growth isn't performing all that well right now. The mid cap growth is going down compared to mid cap value. This is also a concern for the large caps. This is S&P growth to value. It had been showing an improvement. Now it's starting to pull back. And so we're not really seeing that yet in our charts, but we want to be aware of this just to know these things ahead of time as much as possible. Okay, then we keep an eye on inflation. The top part of this chart are commodities. And I'll show another little chart here that I also showed in the weekly video where we are pulling back now. This is a monthly chart, so it takes a long time for this to update. It'll click over once we get into September, but we're actually dropping below the moving average. And we also look at a monthly ratio of inflation versus deflation, and this shows that inflation is going down. And that's why the market, to a degree, based on this type of analysis and a lot of others, is expecting the Fed to cut rates at their September 18th meeting. It's not that they're not going to cut rates, because there's a 100% probability in the market right now. And the Fed, a week ago, Chairperson Powell came out and said, yeah, looks like we're due for a rate cut. That's paraphrasing him. It's not that they're debating cutting rates or not. There was even some talk of doing it at the July meeting. It's by how much. That's what the market's trying to figure out now. Is it going to be a 1/4% cut or a 0.5% cut? The market is pretty much figuring on a 1/4% right now. But we still have some economic reports coming out between now and when that meeting adjourns. And if the economic reports are weaker than expected, especially as coming up this Friday, will be the employment situation report. And if that comes in weak, you might be pushing for a greater rate cut at that meeting to try to stimulate growth. Then here's a daily chart of the CRB index. It's in a downtrend. We're actually getting ready, potentially, to see a death cross here. We're not quite there yet, but commodities have been coming down, but lately have been bouncing back up. Now, this is the chart that I got from Isabel Net, and this is long-term. This goes all the way back into the 1950s, and this is a 10-year annualized return looking at commodities. If you go from 1965 up to about 1980, commodities were going up, and we saw massively high inflation during that time. Well, then we started to come back down, and then people were like, oh, inflation's coming back. Nope. Then commodities got under control. Oh, inflation's coming back right around the year 2000, the dot-com boom and bust. And now we've been seeing more of a sustained decline. They call that deflation. Well, now we're wondering, and this is a forecast here, because we're going out beyond 2024, are commodity prices still going to keep going up? And that could be inflationary. This is sugar and cocoa and pork bellies and gold and gas and oil. And if these prices keep going up, that is inflationary. So we want to watch this. All right, then we look at the Baltic Dry Index. The idea behind this chart is that when this goes up, that means it costs more to ship products, specifically in the Baltics. Well, we've been just chopping around a little bit. We're not really getting a lot of insight from this chart lately. Then some other markets, aluminum, which continues to be in an uptrend, but it's really been pulling back. The blue line's still above the red line. And that's my definition of an uptrend versus a downtrend, is when the 50-period moving average is above the 200. We look at corn, and I'm really enjoying lots of corn these days right out of the fields, but it's continuing to go down right now. Wheat is also going down. So we're seeing a lot of the food areas going down. Fertilizer really hasn't been going up all that much. Of course, this is a real foundation of growing food. Oil, we're watching this mainly for geopolitical reasons, specifically in the Middle East. If there's a real escalation in Israel, or specifically between Iran and Israel, which could include Lebanon, Syria, and anyone in between, then oil may start shooting up. And that would be more negative for the market. Then we're keeping an eye on gas, which is in a downtrend. Okay, no surprise there. It's a presidential election year. And this is a type of inflation that people feel and see pretty much every day. And so, yeah, the politicians, they want to have gas prices go lower, say, vote for me. Look at what gas is doing. It's going down. And we look at a gold to oil ratio, and gold has been doing well. Oil's just been kind of floundering, at least for the time being. So gold has been outperforming oil with this chart. And then we look at oil to the 10-year yield, and we look at the correlation between the two, where it's pretty much neutral for the time being, where we've been seeing oil starting to go back up, at least according to this chart, and the 10-year yield coming down. So they're actually going more in opposite directions, where they were having a fairly strong correlated relationship. When it gets down here to the 0.25 to minus 0.25 area, I consider that to be neutral. All right, then heating oil is going down. Of course, where I'm at right now, there's really no need for heating oil. It's nice and hot anyway. Natural gas continues to decline. We keep an eye on what's called the spot price for diesel. That's not a futures contract. That's looking at what is the price of diesel right now. And overall, it has been declining there. And we keep an eye on copper. When they're afraid that the economy is going to fall apart, copper goes down. When they think economic growth will continue into the future, copper tends to go up. It was really falling down there for a while, but has been going back up, even though it declined the last few days this week. We look at a copper to gold ratio, showing when this is going down, that means copper's underperforming gold. Here's a longer term look at the copper to gold ratio, and then put on here the 10-year yield and the 2-year yield, just to give a little bit more context, where we're seeing this ratio continuing to decline as interest rates now are starting to come back down. We'll look at gold, the gold ETF. This is not the futures contract. It's pretty much chopping sideways near all-time highs. And then we look at the gold ETFs, and it says the physical gold held by all gold ETFs globally. Not really seeing a lot of money going in there. And does that mean that people are buying physical gold instead? Are they doing the futures contracts? Well, the ETF was one of the first ETFs to come out in 2004, 2005, I think it was. And this is a way to participate in the price of gold, but it's backed by gold, the ETF is, but you don't physically own any gold. And that's what people call this paper gold, because it's really, you don't have any physical possession of gold here. And it doesn't seem like a lot of money is really going in here right now. So are people missing this? Do they think this is another false rally, even though gold has been doing quite well? All right, silver also in an uptrend, but pulling back lately, not breaking out to the highs that we were seeing last spring. We look at the closing price for gold on top, closing price for silver, and we look at the correlation between the two, and it only makes sense. Gold and silver tend to move in the same general direction, and we're seeing a fairly strong relationship between the two. They might be both going up or down. It just means they're going up or down together. And then we look at the gold to silver ratio on top. When this is going up, gold is outperforming. When this is going down, that means silver's outperforming. And we're pretty much neutral here when we compare what's happening with the ratio with the US dollar index. Not really getting any insight here. Here's the dollar, even though it's in a downtrend, both on the daily and weekly charts, because we've seen a death cross here. We have been bouncing back up this past week after it really went down pretty severely. Here's also the US dollar index going back 3 years. We broke out above this trend line. We're coming down. We broke below it. Now we're starting to come back up to this trend line. Will this end up providing overhead resistance? Or if we break through this, is that going to turn the dollar more positive? We look at the euro, which has been doing really well compared to the dollar. We finally saw a couple of weeks ago where the euro is in an uptrend compared to the dollar, where for quite a while it was in a downtrend. And we look at the Japanese yen, which has been bouncing back up too. The euro, which has been starting to outperform the dollar, and then the dollar index down below. This is a breakout chart of the euro. And you can see right here where we were kind of just not really going anywhere seriously. Well, finally in August, the euro really started to outperform, even though it's been pulling back lately, but it's in an uptrend compared to the dollar. The Japanese yen, getting close to seeing a golden cross here. It had really been underperforming. And then the whole mess that happened at the beginning of August, that was partly caused by the yen really rising in relation to the dollar. It's settled down a little bit, but still has been hanging on to a lot of those gains. And the British pound to the dollar, also showing that the British pound is doing better than the dollar these days. Then we look at some index ratios. I do show this in the daily video. This is actually really encouraging. We look at the S&P 500, which is the bar chart, and that's a weighted index. So you have stocks like NVIDIA and Google and Apple and Microsoft. They have more of an impact on what the S&P 500 does. Or the equal weight index, it treats all 503 stocks that are in the S&P the same. And when we see this red line sticking pretty close to the bar chart, that means the rest of the S&P is actually participating in the upside. And that's more encouraging. That would be more on the positive side here. We also look at another ratio. When this is going down, that means the equal weight is underperforming. And lately it's been bouncing back up as the equal weight is actually doing better compared to the weighted S&P 500 index. We look at stocks versus commodities, still showing how stocks are outperforming as commodities have been under pressure. Here's an inverse showing how commodities are underperforming stocks. And we look at the NASDAQ 100, which is really starting to underperform the S&P 500. They both have been doing well in 2024, but the NASDAQ 100 is really slowing down. It's not really showing that leadership role. This is another possible concern for us. It's nice when the NASDAQ 100 is outperforming and we're setting new highs with the NASDAQ 100 and the S&P 500 because stocks are in both indexes. When this starts to show some weakness, it's like, okay, what's going on here? Is the market becoming more defensive, getting ready for a decline? We don't know that. We're not seeing a lot of proof, but we're seeing some potential setup signs here that we want to pay attention to. Also, the S&P 100 was really outperforming the S&P 500. The S&P 100 are the biggest stocks in the S&P 500, but now pulling back enough to generate a recent death cross here back in July and still continuing to underperform. But the S&P 500 is actually holding up. It's within a very short distance from setting a new all-time high. We look at the NASDAQ and the S&P 500. Both have been doing well in 2024, but the NASDAQ is now starting to underperform the S&P shorter term, even though longer term it's still outperforming. We look at the NASDAQ 100 and compare it with the NASDAQ, and we saw this happening back last spring. We saw a death cross with this ratio. When the market's really screaming higher like it did in 2023, the NASDAQ 100 leads. Now it's actually following. We'll look at the mega cap growth, the really big monster companies, compare it with the equal weight index, and you can see here where the mega caps were really outperforming, pulled back, tried to improve, but now could be starting to show some weakness. Now, this could always recover and improve, but you can see here up at the top, this is a daily chart where we've been just chopping sideways for the last number of days, and it's not been helping our ratios to improve. And we look at small caps. The red is the ratio between small caps and the S&P 500, underperforming in the longer term, but lately been bouncing back up. And then the blue line is just the S&P 500 itself. Then we look at a ratio between small caps and the S&P. Small caps continue to underperform. We were seeing some signs of life here back in July. That pulled back. Now it could be showing some signs of improvement here. The big software companies not really breaking out, not really busting to the upside, but they are still in an uptrend on the daily chart. The robotics and AI ETF, this has been all the buzz going on in the market. When you look at this chart alone, it's above the rainbow and in an uptrend, not setting new highs. It has to go all the way back to the 2021 highs here to get there, but still not really looking all that terrible by itself. But when you compare it on a ratio basis with the tech sector, it is starting to do better. The robotics and AI ETF has been outperforming lately, but it's still in a longer term underperforming the tech sector. Mega cap growth all by itself, the ETF, really in an uptrend, still looking solid, but it has pulled back to its 50-day moving average. The Dow Jones Composite Average, where instead of looking at the Dow, the transports, and utilities separately, they put it all together in this one average here, and this is looking good. The Dow set an all-time high in Friday's session. The transports have been going sideways. The utilities have been strong lately as well, and that's what's really been helping this average. The Wilshire, this is a daily chart here. We're above the 50-day moving average. We've been going sideways a lot over the last week or two, not setting an all-time high yet, but still looking positive. And here's a big broad market measure, 2,651 stocks the last time I checked, not at an all-time high, but above its 50-day moving average and still in a solid uptrend. Then here's low volatility stocks. These are the stocks that folks get into when they're worried about the market going down, because these stocks tend to hold up better or go down less. Well, look at how we're really breaking out to the upside here. But then we do a ratio with the low volatility ETF with the S&P really underperforming, starting to bounce up here. Then it pulled back. Now it's starting to go up again. This could potentially be more defensive. Then we look at the advanced decline line studies. This is looking pretty good across the board with the NYSE common stock, the S&P, the mid caps, and the small caps. They've been doing well, and they're above their moving averages, and all the moving averages are going up. So this is showing strength in the market. We look at Dow theory, where the Dow did set a new all-time high on a closing basis here on the top. The utilities are bouncing back up and looking better, but they pretty much have been range bound here for quite a long time. The utilities were really breaking out, pulled back, and now starting to break out again. Now, there's a couple of different ways to look at utilities. Are they growth because of all this green new stuff? And we're going to have to change, and we need more electricity. And so these are being pumped over into more growth areas. Or this is also an area that tends to get more defensive before we go into a decline. We're not really sure right now, just keeping that in the back of our mind. The transports just range bound, not really breaking out, not falling apart either, but just pretty much treading sideways. We look at a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming. But we've been chopping sideways here for the last number of months. And then we look at a ratio between the S&P and the transports. When this is going down, the transports are underperforming. They were bouncing back up in July, pulling back, could be getting ready to go up a little bit more. Now, this would actually be more positive for the market. We want the transports to do well. And we look at the correlation between the S&P on top and the transports in the middle. It's not as strong of a relationship, but it is still fairly strong, showing that they're going more in tandem with each other, but not as much in tandem as they had been doing earlier. Then this is both positive and negative. When we look at a new idea behind new Dow theory, instead of using the Dow, we use the S&P going up and near an all-time high. But when we take out the transports and put the NASDAQ in here, look at how we're lagging behind here. This is pretty much a negative divergence right now. We see that even more pronounced here, where instead of using the S&P, we use the equal weight S&P. This is setting an all-time high, and it did on Friday. Well, look at the equal weight QQQs, which is the NASDAQ 100. They've been chopping more or less sideways, not confirming the high that we see. In a more solid environment, if the equal weight is making a new high, we want to see the equal weight QQQs making a new high too. FANG index below its 50-day moving average, but still in a longer-term uptrend. Notice when we had that down day in early August, how we came right down to the 200-day moving average. That was nice because we found support and we bounced up off of that. But now we've been starting to drift as August is turning into September. Here's another chart, longer term. I drew a trend line that's a little bit longer term here, and we're still above that. We actually fell below it in early August. We're able to get back above it. Then here's a shorter term trend line connecting these lows. We're still below this, and we've not been able to get back above this yet. It would be more positive if we could get above this shorter term trend line. ARC just not doing all that well, just continues to float sideways here and is in a downtrend. Then we look at the all world stocks, taking out US stocks, looking pretty good when you compare it to just how it's looking on this chart. But when we compare the S&P with the rest of the world, starting to see a little bit of weakness here. Then here's a monthly chart looking at the S&P to another global index, the stocks in Europe, Australia, Asia, and the Far East. This is pulling back a little bit, but the moving average is still going up. Now, again, this is a monthly chart, so this is very long term here. And we're rolling over a little bit when we measure this using a momentum oscillator. That's a little bit of a concern longer term. And we look at bonds. Bonds have been doing quite well lately, going up based on price here with the total bond ETF. And we're back into an uptrend with the world bond index, going up based on price. That means they're coming down based on yield. Here is the 7 to 10-year Treasury bond ETF. It's been chopping sideways more or less. It did decline on Friday, which means interest rates went up. But you look, we're in a longer-term uptrend. We're still above the 50 level with the RSI, even though the momentum has switched over to negative. We look at a monthly chart of the stock to bond ratio, still showing how stocks are outperforming, even though they've been pulling back. This is a bond to stock ratio on a daily chart. When we were seeing some problems at the beginning of August, this ratio started to go up. Now it's starting to come back down. That's more positive for stocks. We look at high yield bonds, junk bonds, setting all-time highs here. Corporate bonds also in a solid uptrend. And then we look at a ratio between junk bonds, riskier bonds, and more conservative bonds. And this is showing a little bit of an improvement here, but we dropped down below the rainbow. And when this is going up, that means junk bonds are outperforming. Even though they're riskier, they give a higher yield, and folks are willing to take on that risk to get that yield. Well, then we started to fall back down. And as folks were getting out of the junk bonds and getting into more conservative bonds, but now this could be starting to go back up. We'll look at a stock to bond correlation, pretty much neutral right now. We're in this plus 25 area. So we're not really seeing any solid relationship here yet. These are corporate bonds, which are really doing quite well, even though they pulled back lately. They are in a solid uptrend. This is corporate bonds based on price. Here's the 10-year yield with some Fibonacci retracement levels. I show all the charts, all the weekly charts here. We're really not seeing anything from this chart. This is a 40-year chart of interest rates on the 10-year, where we are starting to come back down after we saw 40 years declines of lower highs and lower lows. Now we're possibly heading up into an environment of higher interest rates. And here's another ratio of the S&P 500 or stocks measuring against the 10-year yield, showing how the S&P is outperforming, but lately pulling back. And then this is looking at 3 to 7 year bonds, comparing it with stocks. When this is going down, that means bonds are underperforming. When we ran into some trouble in late July and into August, this really spiked up, and it's still going down. And this would be more positive for stocks if this ratio continues to decline. Another fib chart here with the 30-year yield not really near any fib retracement levels. Junk bonds setting new all-time highs here when you look at just the junk bond ETF. And when we look at the junk bond ETF versus government, more conservative bonds, we were pulling back. We're actually getting ready to see a death cross here with this ratio, but the junk bonds have been improving over the last week. We look at the S&P 500 and compare it with shorter term bonds. We're up out of the rainbow now. That means that stocks are outperforming at least 1 to 3 year bonds. And we look at the S&P 1500, a broad market measure with 1 to 3 year bonds, also showing how stocks are outperforming. So this is not necessarily causing us any concern looking at these charts. And another broad market measure compared with further out bonds, 3 to 7 years, also above the rainbow. No real concern here when we look at the relationship between stocks and bonds. Tech sector. This is where we're seeing a little bit of a concern. We're coming back down into the rainbow when we compare it to 3 to 7 year bonds. And tech is the darling sector of the market. And if this starts to show some weakness, that might be weaker for the market. And then here's the daily chart of the yields. Have we been coming down? The last few days, we've been starting to go back up with the yields. Here's a weekly chart looking internationally where we have US, UK rates at the top. They're the highest. German rates are starting to go back up a little bit, and even Japanese rates are going up. Here's a monthly chart of the price of the 30-year bond ETF. This is starting to show some improvement. We've been in a decline here below this moving average. Remember, this is a monthly chart. We crossed over negative back in 2019. Now we're starting to cross back above the moving average. The longer we stay above this, the more this red line will start to turn up and go. Then down on the bottom, we look at the price of the 30-year bond with commodities. This still is showing that the price of bonds are outperforming. And we look at the volatility of bonds. That's measured by the MOVE index. Then in the middle area, the VIX, that's a measure, the volatility of stocks here. And then we look at the correlation between the two, and they're actually more neutral. This isn't measuring direction. This is measuring volatility of one market to the other market. Then we look at some different sectors. We look at the material sector all by itself, really looking solid right now. But when you compare it to the S&P, yeah, it's improving, but it's still in a downtrend with this ratio. Communication, real growth area here, holding up, not breaking out to new highs, but still in an uptrend. But when you compare it to the S&P, we pretty much have been going sideways and seeing a little bit of recent weakness. And we look at energy, also above its 50-day moving average, looking fairly good, but going really sideways now by itself. But when we compare it to the S&P, it continues to underperform. And we look at the financials, very strong area and very encouraging. We want to see the financial sector doing well. That means that the market isn't fearing another great financial crisis. But we were also looking good back in 2007, too. So this can change and change quickly. That's why I look at these charts every day. I will post them in the daily video, but right now we're not seeing any really big changes. And they're actually outperforming and doing quite well when compared to the S&P 500. Not really breaking out of a range, but they are performing nicely. Industrials, when you look at them by themselves, really breaking out as well and showing some improvement here when we compare it to the S&P, even though they're still in a downtrend. The tech sector really pulled back, coming back up a little bit below its 50-day moving average, and really starting to underperform. And we're getting ready to see a death cross here with this ratio. That's a concern. The tech sector is what really drives the market higher these days. And to see this ratio start to break down is a concern to us. We want to see if it's going to flow through into the daily and weekly charts that we follow. The staple sector, this is like toothpaste and toilet paper, things that you have to have. And this really goes up when the market is getting more defensive. But when you look at it compared to the S&P, it's still underperforming, but it has been showing some improvement lately. Real estate, another area that really got hammered because interest rates are going up. This is really improving now that interest rates are starting to go down. And we're seeing an improvement here, but we're still in a downtrend when we compare real estate to the S&P. Utilities, as I said earlier, is this growth? Is this defensive? We kind of have to look at both sides right now. Utilities all by themselves are really doing well and also holding up fairly well, but not really breaking out when we look at the ratio between utilities and the S&P. We keep an eye on a ratio on a daily basis of the S&P to utilities. When this is going up, the S&P is outperforming, and when this is going down, the utilities are outperforming. We've been chopping around after declining here, and that's a little bit of a concern too. Healthcare, another defensive area. You have to have healthcare no matter what's going on in the economy. Really breaking out, looking solid all by itself. It's still in a downtrend compared to the S&P, but showing a lot of improvement. This is another defensive area to keep an eye on. Discretionary, this has been a disappointing area in 2024. It's in an uptrend when you look at it by itself, but when you compare it to the S&P, look at how it's continuing to underperform. The energy sector to the tech sector, showing how energy is outperforming, and we have been bouncing back up here, and we could be seeing a little sign of improvement along the way, but longer term, the energy sector is underperforming. Then we look at growth stocks and compare them with bond prices. They really had pulled back, but now starting to show an improvement here. So growth to bonds, stocks to bonds are looking all right. And so when we look at some of the areas inside stocks that are causing us some concern, semiconductors, a massive part of the tech sector, really pulling back, fell under their 200-day moving average, then bouncing back up, but unable to get back above their 50-day moving average. Then we look at the 10-year yield and show how it's been underperforming the tech sector. And then we look at the tech sector and show how it continues to outperform the 10-year yield, even though it's been pulling back. We look at discretionary versus staples in a more solid environment. We want to see discretionary massively outperforming staples, and it's underperforming. Staples are starting to really outperform discretionary. That's a more defensive area. And we look at gold to the S&P, just kind of chopping around right now. It's in an uptrend, so gold is slightly outperforming here, but not really breaking out at this time. But gold is breaking out when compared to the US dollar. Broke above this trend line, even though it's been pulling back lately. The dollar was up and gold was down in the last week, and that's why we saw a decline here in this ratio. This is something that I really watch. These are high leverage loans. Look at how they're setting new all-time highs here. Now, as I always say, the people that get into this kind of ETF really know what's going on in the economy. And if the economy was getting ready to fall apart, we would not see this ETF setting all-time highs. The NYC Composite setting an all-time high here. The broader market's actually doing quite well. All stocks also setting a new all-time high here. Emerging markets in an uptrend, but not really breaking out as of yet. The Japanese Nikkei, that was what caused a lot of the problems, at least on August 5th. But we saw problems developing before that. It really started the week before, and we saw that happening. Then it just kind of culminated on that Monday when the Japanese Nikkei fell 12% in one day. And then we're looking at the micro caps, also still in an uptrend here. Not really getting any information. We were watching this for a while because we were seeing the S&P and the home builders ETF really diverging from each other. Now this has come more back into the line, and their shorter term correlation is actually the same. They're going up and down together. Bitcoin just saw a recent death cross here and is still below the 60,000 level. Looking at China and some international markets here, we're going up in China, we're going up with emerging markets, up in Europe, up in Japan, and up in the US. So this is the KST, which is a longer term oscillator. This isn't really giving us any warning signs yet, but we're going to be watching for things. Intermarket analysis, going back to the beginning of 2024, we have gold, even though it's declined, is doing the best, followed by stocks, then oil, then the dollar, and bonds had gone positive based on price. Now they're starting to drop down and be negative again on the year. Then we look at some correlations between the S&P and the dollar. They're actually going in opposite directions. This is why I say the market likes a weaker dollar. When we see this kind of a reading, if the dollar's going down, stocks are usually going up. And so we watch those markets together with each other. The correlation between the S&P and oil, neutral right now. We're not really getting any real insight there. S&P to the 10-year yield, also neutral right now. The tech sector to the 10-year yield, this is actually showing they're going in opposite directions right now. If interest rates start to go up, that puts pressure on the tech sector. Then we look at the S&P to the 2-year yield, improving here, but getting back up more into a neutral area. Then we look at some long-term charts. This is a monthly chart of the NYSE setting an all-time high above an advancing moving average, and the Coppic curve, which is a momentum oscillator, continues to go up. Then this is a daily chart. This is also going up with the NYSE record high percent index. Here's a monthly chart looking at the S&P versus global stocks, showing how the S&P is still outperforming, and the KST is still pretty much flat on this chart. Here's a daily chart showing how the S&P is still looking pretty strong. We're seeing some improvement here with the momentum oscillator after it was starting to turn down a bit. And then we look at a chart here, the S&P looking good. And then we do a ratio between the S&P and the CRB index, showing how stocks are outperforming commodities. Then at the very end, I have a whole list of positive and negative. Now, I have a number of different ways of measuring positive and negative, but for the sake of this particular video, it's positive when the 50-period simple moving average is above the 200-day simple moving average. So growth and value, when you look at them by themselves, they are positive. Copper is still positive, even though it's been bouncing around and been under pressure. The British pound and the euro compared to the dollar are in uptrends. Gold and silver are in uptrends. The dollar, well, actually, this should have switched over to the other side. Okay. We're looking like a downtrend now on the daily and weekly charts. So that's a mistake here. CRB index, even though it's been pulling back, is still in an uptrend. The big software companies, the mega caps, the FANG index, the low volatility ETF by itself, staples are looking positive, the composite average, and then all of the different bonds that we look at based on price are positive. The tech sector and semis, even though they're showing some recent weakness, they are still positive. The high leverage loans, this is rather encouraging from an economic standpoint. To see that setting all-time highs is positive. The Dow, the NYSE Composite, and the Wilshire, those are two broad market measures. The NASDAQ and NASDAQ 100, even though the NASDAQ 100 is outperforming or underperforming the NASDAQ, the mid caps, small caps, and micro caps are still in uptrends. All stocks, which takes U.S. stocks and international stocks together. Emerging markets, not really breaking out, but still in an uptrend. And Bitcoin, really, this should have been switched over to the negative side too. Where we look at the negative part here, this is when the 50 drops below the 200. Bitcoin, and what was that? There was another one that was negative. The dollar should be on this chart. Right now, I just have the Japanese yen compared to the US dollar, even though the yen has been showing some improvement compared to the dollar. And then ARK is in a downtrend. And incidentally, if you're in ARK, we're in a downtrend on the daily chart and on the weekly chart. So thank you. I hope you found this helpful. Forgive me for those mistakes there. But I hope this video gives you some additional insight. This is probably the video that is least watched, but at times it can be one of the most important videos to really get insight into what's happening. So have a really good weekend, and I will talk to you in the next video.